Okay, guys. In this video, I'm going to explain everything you need to know about liquidity concepts. I do believe that liquidity is one of the most important concepts you need to understand to be able to frame high value trades and if you want to increase the accuracy of your trades, I think it's important that you understand liquidity concepts, okay? Because essentially, liquidity is basically what moves the market, okay? So price is always moving from liquidity to liquidity. Okay, so if you are able to identify areas of liquidity, you would be able to know where you can use as target and where you can possibly place your stop loss without it getting hit, and where you can place your entry. Okay, so generally, when you are making an entry, you want to ensure that price has taken liquidity before your entry. Okay, so if you are unable to spot liquidity, you will end up being used as liquidity. Okay, so what is liquidity? Okay, liquidity is basically, in simple terms, is basically resting orders. Okay, resting limit orders. That's what liquidity is. Okay, so when you are talking about resting limit orders, when you are taking a position, when you are placing an order, you want to take a trade, um, you either go long or you go short. In other words, you are either buying or you are selling. Okay. When you are buying, you are going long. Okay. When you are selling, you are going short. Okay. Now, at the point of placing your order, it is either you execute your order immediately or you wait for price to retrace to a particular level before your order is activated. Okay, so let me show you an example on the BTC chart. So assuming I want to sell, okay, assuming price is at this level and I want to sell, okay, maybe I'm currently in, I want to short rather, okay, that means I'm selling. All right, so if price should, if I should execute my sell order immediately at market price, okay, that's a market order. Okay, but if I decide that, okay, I want to enter somewhere here, let us assume I want to enter somewhere when price goes to, let's say, 40,000. Okay, I want to enter at 40,000. All right, and I wait for price to get to that level before placing the order, or I set a limit order that will automatically execute when price gets there. Okay, so when your order gets executed immediately at market price, that's a market order. When your order gets executed later, you place your order now, but it gets executed later at your desired price. Okay, that is a limit order. Okay, so liquidity essentially basically refers to resting limit orders, areas where you have a lot of resting limit orders, or resting orders that are waiting to be filled or waiting to be activated. Right, that's basically what liquidity is. So liquidity refers to the money that is in the market. Okay, that's why you would often see me use the dollar symbol to represent areas of liquidity on my chart. All right. So once you understand that, it's also important you understand how orders get filled. Okay. Why and how orders get filled in the market. Okay. So um when you are placing an order, okay, before your order can be filled or before a trade can be successful, there must be a counter for that trade. Okay, for example, if I'm going long, okay, somebody at that point in time must also be willing to take the opposing end of my trade. Okay, so if I'm buying, let's say I'm buying 10,000 units of BTC, somebody must be willing to sell 10,000 BTC, 10,000 units of BTC. Okay, so for every buy order in the market, there must be a sell order, and for every sell order, there must be a buy order. If there is none, then what that means is that the order will not be filled. Okay, until there is somebody who is willing to take the opposing end of my trade, my order will not be filled. Okay, so I'll have to wait until there is enough liquidity. Okay, so if I want to buy, let me give an example. If I want to buy at this level, okay, I want to buy at 39,000. Okay, if at the point of placing my order, either at market price or as a limit order, okay, if my order get filled immediately, what it means is that there is enough liquidity at this level that I'm buying. Okay. If assuming there isn't enough liquidity where I'm buying, my order will not get filled. Okay. So even though it is market order, if at all it gets filled, okay, it will not be at this price. So if I'm intending to buy exactly at, let's say, $39,200, okay, I've placed my order. If there isn't enough liquidity here, the order may not get filled immediately. Instead, um, it might take a few minutes depending on how liquid the market is at that point in time. It might take a few minutes, and if and when it eventually get filled, I might not get the exact price I wanted. Okay, so I might end up getting, let's say, 40,000. It can be that terrible. Okay, if you are trading an extremely illiquid market, if you are buying at 30,000, you might end up getting 40,000. It can really be that bad. Okay, so the essence of liquidity is to ensure that your orders get filled. So if there isn't enough resting order, somebody who had already signified that he wants to sell at this price level in the order book, okay, if there is none, then my order will not get filled until there is a counterparty for my order. Okay, it's important you understand it. I want to explain the theory behind it before I go to the practical application of this when it comes to trading, placing stop loss, your entries, and all of that. Okay, so I'm trying to explain the dynamics of how this works. All right, so um, when there is enough liquidity in the market, what it means is that the market is liquid. That is, there is going to be quick filling of orders and there will be a reduction in slippage. Okay, slippage is basically when you don't get the price that you wanted to get. Okay, for example, the example I gave earlier where I said, if I'm buying at this level at 39,200 and I end up my order end up getting filled at, let's say, 40,000. Okay, that difference in price, in my desired price and the price at which the order was filled is slippage. Okay, for those of you that use um decentralized exchange platforms, you would be very familiar with the concept of slippage. Okay, you realize that when you are filling your order, if at that point in time the market is not very liquid, there isn't enough liquidity, enough money in the market at that point in time, you won't get your desired price. Okay, you will not. Okay, that's the essence of a limit order. Anyway, when you place a limit order, the probability of you getting your exact price is higher. So when price drops to that level, and if there are enough opposing order that can fill your order, that can take the opposing end of your order, then your price would be filled. Okay, so look at it this way: if as price is coming down, okay, if price is coming down to this level, as price is coming down, if there is a lot of liquidity, meaning there's a lot of orders, resting limit orders at this level, okay, and what kind of orders would be at this level? Most of the time, they are usually buy orders. I'm going to explain why they are buy orders. Okay, so at this level, there are a lot of buy orders. Okay, once price comes there and those buy orders they get activated, what happens? Price goes up. Okay, so when you are taking a trade, you want to make sure you are placing your entry point at a point where there are liquidity. I'm still going to explain how you identify areas of liquidity. Okay? So assuming you want to go long, okay, so you want to identify areas where there is a lot of buy orders, okay, just above your entry. So as price is dropping, price activates those buy orders into your entry point and price goes up. Okay, so if there is a lot of same applies to when price is dropping. Okay, price is going up rather. So if price is going up and you want to go short, you want to wait for price to trade into an area where there is a lot of liquidity, and you place your entry just below, just above the liquidity in the case of a short, and price activates the liquidity or the resting orders into your entry point, and then price drops. Okay, so that's pretty much the basic concept of liquidity. All right, so now let me explain liquidity in relation to stop loss. Okay, now let's assume that I want to go long. Okay, let's assume that price has been dropping and I want to go long. I want to buy, let's say somewhere here or somewhere here. Let me use it. I want to buy here. Okay. When I buy here, in order to prevent the market from, in order to reduce my loss if the market goes against me, I would want to use a stop loss. Okay, so if I buy here, let's say our market price has a limit order I've bought, I'm in the trade already. What do I do? I'm going to place a stop loss. Okay, I'm going to place a stop loss, and the stop loss that I place, where would I place it? It's going to be below my entry, right? Okay, I've entered here, maybe here or here, wherever. Okay, if I assume I entered here, maybe after the close of this candle, I probably might place my stop loss at this low. Okay, or I place my stop loss at this low here. Okay, I'm going long. Okay, if I'm going long, it means I'm what? I am buying. Okay, so if I'm buying, in order for the market, in order not to be at a loss, that means I would need to sell if the price goes below my entry point or reaches my validation point. So I'm selling. That means my stop loss when I'm going long is going to be a sell order. Okay, so it's going to be a sell stop. Okay, so when I'm going long, I'm placing a stop. My stop will be a sell stop. Okay, when I'm buying, my stop loss would be a sell stop to sell if price should go against me. Okay, so there are sell stops at this level. I want to sell at this level. I want to sell at this level. I want to sell at this level. So you have sell stops. Okay, at this level. I'm going long, I'm selling, I'm placing stop loss, sell stops at this level, sell stops at this level. All right. So and the opposite for short as well. If I'm going short, let's say here, I'm going short here, that means I'm selling here. I'm going short. In order for the market not to go, in order for me not to lose money if the market goes against me, what do? I place a stop loss maybe at this high or at this high. Okay, so because I'm selling, don't forget when you are going short, it basically means you are selling. All right, so if I'm selling, okay, if I'm going short, I'm selling, my stop loss would be what? Will it be a buy stop or a sell stop? It will be a buy stop. Okay, so when the market is going against me, when I'm going short, I'm selling. Okay, I'm selling. So, in order not to lose money, if the market goes against me, I would need to buy back. Okay, so I place a limit order. I place a limit order so that when the market gets to that level, it is going to automatically buy back my position. Okay, so that I will not be at a loss. Okay, so when going short, your stop loss is going to be a buy stop. When going long, your stop loss is going to be a sell stop. Okay, so areas where you have a lot of buy stops is where you call buy side liquidity. Okay, so the liquidity in those areas, okay, is buy what? They are buy stops. Okay, they are buy stops. Okay, and the liquidity at areas where you have a lot of sell stops are sell side liquidity. So highs, all these swing highs are usually buy stops, buy side liquidity here, 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 buy side liquidity, and so I said buy side, sorry, sell side liquidity at the lows, buy side liquidity at the top. Okay, swing high, buy side liquidity. So I already explained how you can actually know. All right, if you are going short at the high, you are going short. Okay, you are selling in order not to be at a loss. That means you have to buy when price gets there. Okay, your stop loss has to be a buy limit order. Okay, so um those stop loss are sources of liquidity, okay, because all stop loss are limit that resting limit orders. Okay, so they are sources of liquidity. Okay, so if somebody is intending to buy, okay, if you are intending to buy, you want to buy where there is a lot of what? Liquidity. There is a lot of what? Um, a lot of, what's it called? A lot of buy orders. Okay, where if you want to buy, you want to buy where there is a lot of sell orders rather. Okay, so if I want to buy, I'll be looking to buy at the lows here, at the lows here, at the lows here. If I'm looking to sell, I'll be looking to sell at the highs here because there is a lot of um um buy side liquidity at these levels. All right. So um so that's that. I hope that is clear enough. All right. Now let me explain liquidity in terms of the market makers. Okay. Now, market makers are basically people that are hired or that partners with exchange, okay, with exchange, with brokers to provide liquidity, to put money or to pump money into the market. Okay. Oftentimes when you hear about market makers, you think you've been made to believe from maybe YouTube videos or wherever from just common knowledge that market makers are bad people, like evil people who are always looking to make you lose money. But that is not the case. Okay, market makers are good people. In fact, they are taking a lot of risk for you, for retails. Okay, the reason why they are providing liquidity into the market is so that you would be able to get your order filled whenever you want to. Okay, so they are hired to place orders, okay, to place orders at different price levels. Okay, so even if the market moves, by the time their order gets filled, the market moves against them, they'll be at a loss, obviously. Okay, so that's pretty much what they do. They are basically people that provide liquidity, that are always willing to take the opposing end of your trade. Okay, if there aren't market makers and you are looking to buy or sell at a particular price level, if there is no retail, there is nobody who is willing to take the opposite end of your trade at that moment in time, that means your order will not get filled. Okay, so market makers are always available all the time. There is a mechanism. There is the way they approach the market. It's a kind of different, okay, because they have to create a kind of order books, and the way they make money is from the difference is from the spread. The difference between the bid and ask price. I don't want to go into that detail anyway, but what you just understand is that market makers provide liquidity into the market. Now, When their order get filled, when they take the opposite end of your trade and they are at a loss, oftentimes they might want to. It's not legal, okay? It's not legal for them to um, use huge funds to defend their position, but we know they do. Okay, we know they try to defend their position. Either they try to sell at minimal loss, or they put in more money to push price up so that they can exit, and then the price dumps afterwards. But they will try to defend their position in order not to incur too much loss. Okay, now there is a little difference between BFIs and market makers. So that's why I like to use BFIs, banks and financial institutions, instead of market makers. Okay, especially in forex. Okay, banks and financial institutions can act as market makers, but not all banks and financial institutions are actually market makers. Some banks and financial institutions only simply trade the market. They have huge funds to trade the market. Okay, so these are the ones that we can say sometimes might want to hunt your stop loss. All right, these are the ones that can say that okay, they sometimes might want to hunt your stop loss. Okay, so let's see if the banks and financial institutions, if they want to buy, okay, they want to buy. Remember, I mentioned that when you are buying, or when you are taking any trade, okay, you are placing any order, there has to be somebody who is willing to take the opposing end of your trade. Okay, so if these banks or financial institutions, if they um if they want to fill their orders, okay, that means that they have to look for, because of the volume of their orders, they sell and buy in large volume. Okay, oftentimes they can't even sell at once, they can't buy at once, because their orders are so huge that there isn't enough liquidity in the market to fill it. So they buy it in succession. Okay, so assuming they buy here, okay, that's why you see price going up, going down, and going up. So assuming they buy here, um some orders have not been filled, price is going up. Okay, when price comes down again, they're buying again. Price comes down, they're buying again. Okay, so how does this work? Let me explain. So assuming market makers, they want to buy, all right, they want to buy, let's say, at um let me show the full BTC picture. Okay, so this is BTC. Okay, market makers are interested in buying. Okay, they want to get involved in the game. I don't want to use market makers. Let me use banks and financial institutions, whales, people with huge funds. Okay, they may not necessarily be market makers. All right, they may not necessarily be market makers. So I think I'll just stick with banks and financial institutions, BFIs. Okay, so when BFIs wants to buy, maybe they've never really been interested in Bitcoin. Okay, but they see that assuming I bought Bitcoin here and the price is going up, get to this level, I would have made a 50% profit within roughly a year. Okay, so if they want to get involved, obviously it would be stupid for them to buy here. Where would they be looking to? Even if they want to buy here, um, it's almost impossible for them to buy here, because at this level there wouldn't be a lot of sell orders. All right, don't forget, people are buying, people have been buying, people have been buying, people have been buying. At this level, there wouldn't be a lot of sell orders yet. Okay, so what they do is they try to push the price down. All right, they try to push the price down to areas where there is a lot of liquidity. All right, and they start buying. They start dollar cost averaging all the way down. Okay, when it gets to that price level, all the way down. Okay, so let's look at it from this level. Remember, I told you that um There are sell stops at the lows, because you are going long. Those that buy here probably place a stop loss here, stop loss here, stop loss here. So when price comes there, they will be looking to buy. They will buy into their sell stop. Okay. Don't forget. So they place their order at this level because there is sell stop here, sell stop here. So that's a lot of liquidity they can buy into. Okay. So they will buy at these levels, these lows. So once they buy, that's why once a low is taken, oftentimes you will see that price will react, price will kind of like go up. Okay, look at this low here as well. When this low was taken, you can see the price went up because they bought into the sell stops or the sell side liquidity at these lows. Okay, so if they want to buy, what they do, they look for areas where there is a lot of liquidity and they place huge orders there and attempt to push price down to that level. Okay. Now, let me quickly say that there is an algorithm that controls price. In code, there is an algorithm that tries to balance the dynamics between supply and the demand. Okay, and this algorithm is constantly trying to push price to areas of liquidity. Okay, now let me explain. Look at this bull run. As price was going up, going up, going up, going up, going up. Okay, price was just literally shooting up and up and up. All right. Um, that means there's a high demand. There is high demand for BTC, so demand is extremely high. It will get to a point when there would be an imbalance between demand and supply. Okay, so people just want to buy. People just keeps buying. Nobody's selling. They want to hold on to their dear life, and all of that. Okay, so the market or the algorithm cannot continue to fulfill people's orders because there isn't enough supply to fulfill those orders because a lot of people are not selling. All right. Now, um, what the banks and financial institutions attempt to do because they know they cannot get their order filled at these levels because here there is a lot of demand. Okay, people, that's when a lot of retailers are looking to buy. Most retailers buy at the top. After it has pumped, that's when they don't want to be left behind, and then you see them, they would buy. Okay, you see them, they will buy, and demand is high. Okay, so once demand is high, contrary to what you know in economics, where price continues to go up forever, it is not like that in the financial markets. Okay, because for every demand, okay, there must be a supply for it. Okay, so for every buy order, there must be a sell order. Okay, because at this level, there are a lot more buy orders than sell orders. The algorithm would push price to areas where there is enough sell orders. Okay, that's what happens. The algorithm will begin to push price, deliver price to areas where there is a lot of sell orders. And don't forget, I said that when you are going long, okay, you are going to place a sell stop to sell if the market goes against you. Okay, so at these lows, their sell stop. Okay, so those are sell orders. Those sell orders are liquidity. Okay, so price will be pushed down to activate those sell orders in order to fulfill the orders of those who are looking to buy. Okay, so if you are looking to buy, don't forget you need sell orders. You need people who are willing to sell to you. So price will push the price down to activate those sell orders. Okay, so these are the levels where those banks and financial institutions with huge funds, these are the levels where they are looking to buy. Okay, so all these lows here. So this is why I had always been saying that BTC is going all the way down to this level. Okay, BTC will get to 28,700. It will. It will get here. It's just a matter of time, except if um the BFIs are not interested in this level. At this level, there will be a lot of sell orders. That's a huge amount of liquidity. This level, this level, this low, this low, this low. And if they are still interested, they can still go as low as this level, okay? As low as 17,000, as low as 16,000 until they are satisfied, okay? Even as low as this 9,000, okay, until they are okay, until all their orders have been filled, even as low as 3,800. Maybe that's kind of extreme, but it's possible. Okay, it's possible. If they feel they want to, these are people with a lot of money. Okay, these are people with huge funds. If they are not satisfied with, they've not filled all their orders, they still want lower prices. All they would keep doing is place huge orders at those levels. Okay, they'll place huge orders at those level, and um like I said, the algorithm is designed to seek liquidity. So the algorithm would push price down to those places where there is a lot of huge orders, okay? Especially when demand is high. When demand is high, okay, when demand is at its peak, price will not continue to go up forever, okay, because there isn't enough supply to balance the demand, okay, to fill the demand. So the algorithm is designed to push price down to places or areas where there is a lot of liquidity. Okay, so um that is pretty much what happens. So these lows, there are a lot of sell orders. That's where they want to buy. They want to buy into their sell orders. Okay, so if you want to buy, they need sell orders. So you will look for areas where there is a lot of sell orders. So you can see that these lows, they've bought into these lows, they've bought into these lows, they've bought. You can see that even before those lows, you see that a lot of times there's usually some kind of pump. Okay, before this low, you can see there was some kind of pump to make people go long and place their stop loss. So when you go long, you place your stop loss somewhere here. Don't forget your stop loss is sell orders. And then by the time the price is pushed back down, your sell order gets activated, takes you out of the market, and they buy into it. Okay, so they fill their buy orders. Okay, they target the next low. Okay, so I won't be surprised before these lows are taken, this low, this low, this low, we will most likely see a pump. In fact, I was actually expecting a pump somewhere around here, around that 36, 35K level, okay, before this low would be taken, but we didn't get a pump. So before these lows will be taken, most likely they would induce people to, okay, anyway, they've already induced people to go long before. So perhaps it might just drop down to take out those lows before it pumps. Maybe since they've already induced people to go long here and they are already stop loss at this level. Okay, so um perhaps we might get a little bit of a pump here to induce people to go long again, place stop loss, and then they push price back down to activate their stop loss, and then maybe they sell or they buy into this demand zone here. Demand zone at 30,000 thereabouts, or 31,000, between 30,000 and 31,000. So we might get a pump from there, from this level. Okay, if price gets there. Okay, so um I'm not doing BTC analysis anyway. I'm just trying to show you examples of what I mean by liquidity. Okay, so now let's put it in context. When you are going long, okay, you want to make sure that there is liquidity before your entry. All right, you want to make sure there's liquidity before your entry. Okay, so if you look at this um this first pump here, you would see that, okay, after price form the low, form the high, it has induced people to go long. This pump right here, it has induced people to go long. Okay, this has induced people to go long. They place a stop loss here. They want to buy. What happens? They push the price down to take out that low. Okay, don't forget their sell stop. So they buy into their sell stop. Once that low is activated, you can see the way price aggressively pushed up. You can see the imbalance that was left there. So that's means huge orders were filled. Okay, so price formed a low, price goes up, they push price down to take out that low, they buy into their orders to activate their sell stop, and then price goes up. Okay, don't forget before price goes up again, we have another low here. Okay, induce people to go long, they place their stop loss in there, they push price back down again to activate their sell stops so that they can buy into it. Okay, I already explained the mechanism. Okay, for every buy order, there must be a sell order. So when they want to buy, they need people who are willing to sell. Okay, so even though you are not willing to sell, but your stop loss is there, your stop loss is meant to sell. Okay, so and then they buy, price goes up. Okay, price goes up. They are not still satisfied. Okay, you can see this low that was formed again, a low form, the price is going up again, people go long, place their stop loss at these levels, they push price down again to activate their sell stop, and they buy into it. Okay, and what happens after that? Price went up. Okay, so usually when sell side liquidity is taken, price will go up. When buy side liquidity is taken, price will go down. All right, so sell side liquidity activated, price goes up. This is a low, activated, price goes up. So if price, a time price should come back to this level, activate these ones, you can see that's exactly what happened. When price came back down again, it induced people to go long again. They place their stop loss, they push price down, took out the sell orders here, the sell orders here, the sell orders here as well, and they bought into this um demand zone. And what happened after? Price went up. Okay, price went up. Okay, so they fill their orders, price went up, and they would need to sell to make profit, obviously. By the time price was coming down here, don't forget that you are placing, you are selling. Okay, so your stop loss is a what? Is a buy stop. Okay, so if price goes against you, you want to buy back your position so that you will not be at a loss. So what they want to sell, they are going to sell into your buy stops. Okay, your buy stop is like the opposing end of their own trade. So by the time they sell into your buy stop, what happens? Price goes down. Okay, and then by the time price goes back up again, by the time they push price back up again, you can see this is buy stop. Buy stop was taking, these highs here are also buy stops. They were taking, and then what happened after? Price went down. Okay, you can see how the engineer liquidity, you can see the same thing everywhere. You see it everywhere. You can see this low again. This is a low. Okay, price goes up, induce people to go long. Okay, they place their stop loss, they push price back down again. Okay, once they push price back down, they take out their stop loss. Okay, they activate their stop loss and buy into it. Okay, they buy into it. Okay, once they buy into it, what happens? Price goes up. Okay, price goes up, and when price came back down again, you see that price forms a low. When this low was, when the stop loss at this level gets activated, what happened? Price goes up. Okay, and people go long again. They place stop loss, which is a what? Which is a sell stop. Okay, they activate the sell stop again. So actually, all the way down here, banks and BFIs are accumulating. Okay, they're basically buying. Okay, they're accumulating their position. They're buying and selling and buying and selling. That's how they do. That's what they do. Okay, so this aggressive drop that happens here, you can see each time they buy, it's usually aggressive. Okay, you can see by this imbalance that it left behind. Okay, It's usually aggressive. It's rather an aggressive sell-off. Okay, and that continues and continues and continues. So when you want to go long, you want to ensure that there is liquidity before your entry, before you go long. Okay, if you want to go short, you want to ensure there is liquidity before your entry, before you go short. Okay, now let's look at examples. As I want to go short, this is a supply zone. So I'm looking to sell at the supply zone. Okay, you can see from here that liquidity was induced. All right, this is a high, this is a high, this is a high. So you know that when those high, when they get activated, you can see how price reacted. The highs here, you can see the way price reacted at this level. This one, so when it was taken, you can see the way price reacted. This one as well here, when price traded into it, you can see the way price reacted. And then price eventually went up, took all the liquidity, and then dumped back down. Okay, same thing applies there. You can see there is a high here, there is a supply zone here. Price took out the stop loss at this level. People were trying to go short, and what happened? They sold their position into their buy stop. Okay, so let's look at a few models that allows you to see areas of liquidity. So equal lows, equal highs. Okay, so this is one of the reasons why I have been saying, for those who have been on Crypto Academy, I had been saying from, I think from around here, that BTC is going to take out this low, most likely. Okay, or at least take out this low, take out this low. Because they want to buy. And it can even really get worse than it is. It can go as low as 17,000, can go as low as this low here. It can get really bad. It can get that bad. 3,790 something. It's a possibility. All right. You can't rule it out. It's possible. Okay. It does depends on how greedy these guys. It just depends on how greedy they are and the fear in people. Okay. So anyway, this is not a Bitcoin analysis. If that happens, it's going to present a lot of opportunity anyway. But um we take it level by level, all right? Best to just take it level by level, level by level, and take profits. You know, when a bear market can still get really worse, it can still get really worse. So it's important to know that. Okay, so let's look at a few models. Like I said, this equal lows, equal highs. You can see from here, there's relatively equal lows here. So a high probability that when price trades into this low, we should get some kind of bounce. This is also a low here. We should get, if we don't get a bounce before it takes out this low, I strongly do believe we'll get a bounce before price takes out this low here. I strongly do believe we'll get a bounce. If we don't, if we take out this low, then there is a very high probability that you can say this is an equal low. Okay, this is an equal low here. Okay, this is an equal low. Right, so if price trades it to this level, we would most likely get a bounce. Okay, we'll most likely get a bounce, probably to even 50k or 55k to fill this imbalance. That's possible because this is also an equal high. So if they're looking to sell, they might sell into this 52k, sell into this high, sell into this high. There are also highs here anyway, so it might not come this high, but it's a possibility. That's what I'm training you. Okay, so when a high is taken out, most likely you would see a reversal. Okay. Okay, let me show you some other examples on Euro USD. You can see that these ones are even more vivid. When a low is taken out, took out this low, price went up. Okay, and when a high is taken out, you can see this high was taken out, this high was taken out, this high was taken out. price goes down. All right. So um, when a low is taken out, especially equal highs. When the high is taken out, okay, you wait for market structure shifts, and you will most likely see that price will drop after. When a high is take when a low, I mean price will go up rather. When a high is taken out, okay, you wait for market structure shifts, and after that price drops. When a low is taken out, you wait for market structure shifts, and after that you most likely see that price would go up. Okay, so when you are taking a trade, you want to make sure that um, liquidity has been taken. So buy side liquidity or sell side liquidity has been taken before you enter that trade. And when you are looking to take profit, you can target the equal lows and equal highs as your take profit. Now, trend line liquidity, um, okay, trend line liquidity. This is an example of trend line liquidity. Basically, something like this. Okay, so when price trades and takes out the liquidity into a supply zone, price drops. Okay, and it can also be in the form of same thing applies for longs. I mean, okay, same thing applies for longs. Can't see a long example here now, but this is an example. I can see a good example on FTM here. What you just know is um, when you see a trend line liquidity like this and you're approaching a demand, I mean, you're approaching a supply zone, you can target the lowest liquidity there as your target. Okay, so price will most likely take it out. So if there is also a demand zone somewhere here, there's a demand zone here. Okay, you know that price is taking liquidity all the way down. Price has taken this liquidity, so you are likely going to see a reversal. So demand zones and supply zones where there is liquidity before it are high value zones, and they are more likely going to hold. Okay, and range, when you have a range, when price breaks out of that range, if price should come back into the range, it will most likely um cause a reversal. So if a range is formed like this, what you most likely see is that when price takes out one end of the range, then you see an aggressive drop. Okay, this is like the mechanism behind the accumulation, um, manipulation, expansion setup that I shared on the Telegram group page. Um, okay, you have a range. Price takes out the liquidity on one hand, and you see it drop. Okay, in forex, there is timing to these things. During Asia range, you see price is moving in sideways, and then just before the New York zone, the London section, what you see is price will take out one end of the range and then expand the opposite end. Okay, so swing highs and swing lows also has a lot of liquidity. All right, swing highs, swing lows. On the swing low, you have a lot of sell side liquidity. On the swing high, you have a lot of buy side liquidity. Okay, so once you see these areas, um, this area, for example, there is a lot of sell side liquidity. So if BFIs are looking to buy, they'll be buying somewhere around here. Okay, somewhere around here, that's where they'll be looking to buy. And what happens when they buy? Price goes up. Okay, when you buy, there is huge demand, price goes up. Okay, this is basically the mechanism of how the market works. Okay, so let me show you a few trade models based on liquidity. Okay, this is an example of a continuation entry. Price is dropping, price is on a downtrend. Okay, trade up, creates a supply zone, and you see a trend line liquidity built after there is market structure shifts. When price trades up, you can see there is liquidity before that supply zone. What it means is that that supply zone has a high probability of holding. Okay, so that supply zone will most likely hold. Okay, and then price trades into it, and then you see it drop. Okay, let me show you an example on BTC. Um, okay, you can see this. Okay, price is on a downtrend, creates a trend line liquidity somewhere here. The trend line liquidity, price goes up, trades into it. You can also see this high here. This is a high. This is also liquidity. Okay, this is also liquidity. You can see it has induced people to sell, to go short here. Okay, price goes back up, sell, they sold into their order, and then you can see the demand zone held. What happened after? Price continued down. All right, same thing applies here. You can see liquidity that was built. This is the demand zone. This is supply zone before price got there. Price got there, price was pushed back down. Okay, so generally, of course, you can see from here there is really no liquidity. No liquidity was really built. This is liquidity anyway. This is a swing guy. Price went up and dropped, went up, came down, but not really very significant. But it's not the time you will see liquidity being built into an entry point. But when you see liquidity, that entry point has a that demand or supply zone has a very high probability of holding. Same thing applies there. You can see the swing high, sell side liquidity, buy side liquidity, they buy into it, into this demand zone, and what happened after? Price drops. Okay, so we have sell side liquidity. This has been taken, this has been taken. The next one are those ones at 28,700, around 30K. Okay, so price may drop to that level before it goes up, but I honestly do believe that since we've taken two sell side liquidity here, we should see some kind of um we should see some kind of pump, okay, at least to this level to mitigate this supply zone, at least, okay, at least, or maybe this level. All right, so um that's pretty much all you need to know about liquidity. Let me show you one more model for reversal. Um, okay, so this is a reversal setup. So let's assume that price is trending up, okay, and then we have a break of structure. Okay, we have market structure shifts to the downside. Okay, this is the supply zone that broke market structure to the downside. So price is going up, and you have equal high formed before the entry point. Once price trades into it, we will most likely see a reversal. So this supply zone has a high probability of holding because of this equal high that formed here. Okay, so I hope my explanation is simple enough. If you have questions, you can always drop it on the Telegram group page, or you can even drop it on the YouTube comment section. Okay, you can drop it. I will always respond to it. All right. Next, I'm going to cover demand and supply zones. Okay. Thank you.